Hello and welcome to Trading 5 Talents. In today's video, I want to go over another options trade that can potentially yield unlimited profits. The trade that I'll be covering is called a strangle. Now, a strangle is an options trade in which you would purchase both a call and a put with the same expiration, but a different strike price. Now, it's very similar to a straddle trade that I covered earlier, in which you buy a call and a put, same expiration and same strike price, but a strangle is call and put, same expiration, but a different strike price. And because you're purchasing both calls and puts, you are going to be entering this trade for a debit. The example that we'll use is AMC. And if you remember our price line, left to right, low to high in terms of price, and the dotted vertical line represents our current market price of the stock. So what we'd be doing to set the strangle up is, first of all, we would purchase a call just above the current market price. And in this example, it would be a $13 strike. So we'd purchase that call, and you can see the green icon on the top of our price line, meaning that we're going long or we're purchasing that call. And then we would also buy the put just below the current market price of AMC, and that would be the $12 put. So you can see we're purchasing both of these. The call is going to cost us $1.55. The put will cost us $1.37 for a total debit of $2.91. So because these are options, we multiply it by 100, and that would be $291 that we would need to use in order to put this strangle trade on. So the profit is going to be the same as the straddle trade. So the max profit that you can make can't be calculated because it all depends on how far the stock moves away from the strike prices that you purchased. So if the stock just crashes for whatever reason, this is going to make money. Or if it moves up because of maybe great earnings or some other factor, it's going to make money. So the further it moves away from the strike prices, the more money you can make. And it's calculated to be an unlimited amount of profit. You can see that here. The max profit is unlimited. The max loss is simply how much you paid to enter into the trade, and that is the debit that you paid. In our example, it was $291. So let's take a look at option strat, and we'll set up this trade so you can see the profit and loss graph. Here we are on option strat, and we're going to go over to build, and we are looking at a strangle trade, and that would be down here. So I will click on that. All right, AMC is already up here, and I think we were looking at May 27th, and we were doing the 13 call and the 12 put, like this. All right, so let's zoom out, and here is what that trade would look like in terms of profit and loss. So the current price is this vertical dash line right here. And then our strikes are 12 and 13, which it's currently around $12 right now. $13 strike price would be on this side. So this is the max we can lose, is just how much we put in. And in the time of making this video with using option strat, you can see it was $1.60 or $160 max loss. And then the further away the price moves from the strikes, that's when you can start making money. Like the straddle trade though, time works against you. So you can see these break evens here in blue. So the closer you get to expiration, those blue break-even lines move further apart. That is, the stock has to move further and further away in order for you to be profitable. But as soon as you put the trade on and you have a lot of time until expiration, then those blue lines will be much narrower and the stock doesn't have to move as far in order for you to be profitable. So you can see right here at expiration, there's 7 days until expiration in this setup, $10.40 and then $14.60 are the break evens. You can also see that right here in the break even, $10.40, $14.60. But if we moved the expiration to the day we put on the trade, and now you could see the blue lines, the break even is $11.40 and $13.11. At expiration, it would have had to have moved past $10.40 or $14.60. So now you have maybe another dollar or even more than $1 of safety. So you've got $11.40. It only has to move down to $11.40 for you to start making money instead of $10.40. It only has to move to $13.11 instead of $14.60. So again, time works against you with these long plays, a long straddle, a long strangle. So you just want to be cognizant of that as you put these trades on. You want to give yourself enough time to capture that potential movement in the underlying stock. All right, let's look at the advantages of a strangle. So the advantages are that there are large profits that could be made if there's a large move in that underlying stock. And you don't have to be correct on the direction of the move. The move can be bullish or it can be bearish. That is, it can go up or it can go down. As long as there is a move, you can profit from this trade, just like the straddle trade. However, the disadvantages, like the straddle trade, is that it's expensive because you have to purchase both of these. However, I would like to point out that usually with a strangle, it's usually cheaper than putting on a straddle, because when you put on a straddle, both of the options, the call and the put, are at the same strike price. And if you're playing this trade or putting on this trade that's close to the money, then one of those options, either the call or the put, is going to be in the money. So it's going to be more expensive to purchase that one. But when you do a strangle and you're playing it at the money, then you would be purchasing these options, both the call and the put, slightly out of the money, so it would be cheaper. So it's not going to be as expensive compared to a straddle if you're playing it the same way on the same ticker, but it still can be expensive because you are purchasing two different options. So because of that, there's going to be a slightly longer order fill times and more commissions because you're purchasing more options. So like the straddle, once again, small moves and time will have a negative impact on this trade. You need large moves, and you want to make sure that you have enough time so that theta decay doesn't eat away at your potential profits. So if you want to invert the strangle, you can do a reverse strangle, an inverted strangle, or a short strangle. Those are all similar names. And instead of buying these options, you would simply sell them. I'm not sure if all brokers would allow this because there could be unlimited loss and now you're selling naked options. What I would recommend instead, if you're looking for something to stay within a narrow range, is possibly use an iron condor. And there's a video I made regarding the iron condor where you make your max profit if the stock stays within a specific range. And if you expect it to move out of a specific range, then a straddle or a strangle might be a better play. So if you have any questions about this trade or any of the other trades that I've mentioned recently, then go ahead and leave a comment down below or ask me on Twitter at Trading5Talents. And if you want more information about how I use options trading, specifically the wheel strategy, that's selling puts and selling calls, to pay monthly bills, then go ahead and click on the subscribe button and turn on the notifications so you can catch all of those updates and upcoming videos. Until next time, trade wisely and take care.